Did you know that a simple election on your US tax return could expose your worldwide income to US taxation? For many international couples, electing to treat a non-resident alien spouse as a US resident seems like a smart move, but it can quickly become a costly tax trap. In this video, I will break down the risk using official IRS guidance so you can make an informed decision. This presentation is for educational purposes only, and it is not a legal or tax advice. Under US tax law, a non-resident alien married to a US citizen or resident may elect to be treated as a US resident for tax purposes. This election is authorized under Internal Revenue Code sections 6013J and 6013H. According to the IRS Publication 519, this allows the couple to file a joint U.S. tax return as married filing jointly. At first glance, this seems beneficial. Filing jointly often provides lower tax rates, a higher standard deduction, and eligibility for certain tax credits. But what many taxpayers overlook are the long-term consequences. Once the election is made, the non-resident alien is treated as a U.S. tax resident. This means their worldwide income becomes subject to U.S. taxations. This includes foreign employment income, overseas investments, rental properties abroad, dividends and capital gains, and foreign business interests. Even if the income is earned and taxed overseas, it must still be reported to the IRS. This is the one that is most misunderstood, and it is also dangerous consequences of the election. The non-resident alien is also exposed to additional reporting obligations. Electing to be treated as U.S. resident also triggers extensive reporting requirements. This may include the Foreign Bank Account Reporting (FBAR) or FinCEN Form 114, Form 8938 and FATCA, Form 3520 for foreign gifts and foreign trust, Form 5471 for foreign corporations, and Form 8865 for foreign partnerships, among others. Failure to file these forms can result in severe penalties, even when no tax is owed. For many international families, compliance costs alone can outweigh any tax savings. Another major drawback is the loss of favorable tax treatment available to non-resident aliens. Okay? By making this election, you may lose access to certain treaty provisions or positions, preferential withholding rights, and the ability to exclude non-US source income. Additionally, income that was previously outside the United States tax net becomes fully reportable. This can significantly increase your overall tax liability. Okay? The election can be revoked and reversed. Okay? According to Internal Revenue Service Publication 519, once the election is made, the election remains in effect unless it is terminated or revoked the following years. If revoked, it generally cannot be made again without IRS approval. Okay? So, you needed to be really thinking about if you wanting to do that election if you are a non-resident alien. Okay? But There is also a benefit. Despite the risk, the election can be beneficial in certain circumstances. Okay? So the following can be advantages when you make that election. It may be advantageous when the non-resident alien has little or no foreign income, or the couple wants to claim the full standard deduction. They qualify for valuable tax credits, or they intend to reside in the United States long term. Okay? The key is performing a comprehensive tax analysis before making the decision. For cross-border couples, particularly those involving Australia and the United States, the implications can be significant. Electing U.S. residency may create double taxation risk, trigger complex reporting requirements, and affect long-term financial planning. So professional advice is essential before proceeding. If you found this video helpful, please like, subscribe, and share it with someone navigating U.S. international tax rules. If you are considering this election and need expert guidance, book a consultation, email us at hello@usautax.com. See you in the next video.